Welcome, everyone, to our employee ownership deep dive. We are focusing today on employee stock ownership plans, or ESOPs. And this workshop is sponsored by the North Carolina Employee Ownership Center and the Small Business Center Network, based out of Forsyth County. The North Carolina Employee Ownership Center is the hub for information on employee ownership for the state of North Carolina, and we have a mission to educate the state about employee ownership as a potentially good option for business succession. Encourage you to go check out our website. We have a ton of videos, stories, and resources there for you. So I would love for everyone to introduce yourself in the chat. If you wouldn't mind listing your name, your organization, where you're based, and what is your main goal for attending today? Or do you have any burning questions about ESOPs that you are looking to have answered? So again, please introduce yourself in the chat, and I will be monitoring the chat throughout. So feel free to put any questions in the chat at any time. All right, why are we here? We are at a really interesting moment. We are faced with a demographic trend leading up to the year 2030, when all of the baby boomer private business owners will be retiring. And baby boomers own almost half of all privately held businesses in the US. So this is a big moment. It's actually the largest wealth transfer in history, and many businesses may end up closing. In North Carolina, there are about 79,000 business owners that are aged about 55 and older, so reaching retirement age. That represents a payroll of 32 billion, revenue of 165 billion, and 879,000 employees. And it's in all different industries and sectors throughout our state. So this is a big deal. We have this tool on the NCEOC website that you can mouse over any county, and you can see the percentage of businesses owned by people of retirement age in that county and the number of businesses. So here, for example, in Forsyth County, it's about 55%, about 3,000 businesses. So it's a trend that's pretty significant, that's affecting our entire state. And more than half of all small business owners don't have a succession plan. Keith was just telling us a story about a business owner who didn't. And so this can have a big impact on employees and communities and businesses and customers. So it's really, really important to have a plan for who is going to own or run your business after you retire. It doesn't mean that you're retiring, actually. It just means you have a plan for what happens next. The 5 Ds that could impact your business are death, divorce, disability, disagreement, distress. That could include things like flood damage, pandemics. There's lots and lots of factors why a business might need to close in a hurry. And so we really encourage people to have a plan for what happens next. There are lots and lots of options. Of course, a lot of people would like for their children to take over their business or some other family member. That's a good option. But we do hear that after about the 3rd generation, businesses tend to sell out of the family. And so there may not be family members interested or capable of running a business. The next most common option is a management buyout, and that's a great option. Those are people who know your business, who have run your business, that you trust. So that could be a good option. You could also have an outside purchaser. That could be a supplier or a customer or even a competitor. We're seeing private equity firms coming in and buying up businesses in different industries. So that is an option. But oftentimes some of these purchasers are buying the business for the customer list and maybe are not going to keep the business going the way that the owner wants it to go. So there are other options. Of course, some businesses unfortunately close down. But what we are going to talk about today is employee ownership. So employee ownership is a system where the employees own a portion or all of the business. And it is a way to protect the legacy of the business and the business owner. It's a way to reward employees who help build the company. It's a way to keep those jobs in those communities. We know that locally owned businesses, much more of any dollar stays in the community if it is locally based than if it's based somewhere else. And there is potential beneficial tax treatment. So we'll hear more about that today with ESOPs. And we've seen there's a lot of research from the National Center for Employee Ownership and Rutgers showing that employee-owned firms that have a strong, engaged ownership culture perform up to 10% better than those that do not, and have greater ability to attract and retain great employees. So employee ownership can be a fantastic option. And we have a lot of great employee-owned businesses here in North Carolina. So there are at least 170 firms based here that are wholly or partially owned by employees, and 750,000 employees that are benefiting from that. And this is just a few of them. You probably know some of these businesses. Our State Magazine is actually employee-owned by an ESOP. Quaintance Weaver, the Proximity Hotel, and the O. Henry Restaurant, those businesses are ESOPs. Mass General Store is an ESOP. M.B. Haynes and Valdez Weavers, Columbia Forest Products, Salem Fabrication Technologies. These are all fantastic ESOPs. And then there's also some co-ops and some employee ownership trusts here. So the types of employee ownership, by far the most common is the Employee Stock Ownership Plan, or ESOP. There's about 6,500 ESOPs in the US with about 15 million participants. And we're actually seeing some M&A in the ESOP space. So there's more participants, but the number of ESOPs is staying about the same. We're seeing more worker cooperatives for smaller businesses, about 612 with 6,000 to 10,000 participants. And then we're seeing more employee ownership trusts. So that is a form of employee ownership predominant in the UK, but it's a good option for businesses, again, that are too small for an ESOP. And we've got about 50 in the US and a bunch more underway. But today we are going to focus on ESOPs. So an ESOP is actually an employee benefit plan that is regulated by federal retirement law, or ERISA. And this benefit plan can set aside or borrow funds to buy the selling shareholders shares of company stock. Those are put in a trust. They are allocated to individual employee accounts. They vest over time based on a vesting schedule, and they're eventually cashed in when the employees retire or leave the company. And we do see 30-year ESOP employees with 5- and 6-figure ESOP accounts, which is very significant. And there are significant tax benefits for both the selling shareholder, who can defer capital gains indefinitely, as well as 100% ESOP companies. If they become an S Corp, they are tax exempt. So ESOPs are a fantastic option, and we're going to hear today from Optima Engineering. So before I introduce my speakers, for those of you who have just come in, if you wouldn't mind putting in the chat your name, your company, where you're based, and any questions that you might have about ESOPs or what brought you here today. So first, we are going to hear from Keith Pehl, the CEO of Optima Engineering, who sold his business to an ESOP 4 years ago. And then we're going to hear from Ethan Stambler from SES ESOP Strategies, who is a company that helps businesses become ESOPs. And he's going to tell us the process, the timeline, and some things to keep in mind. So with that, let me turn it over to you, Keith.
All right. Thank you, Annie Claire. I noticed that photo of me is quite old because I am now a member of that Silver Tsunami group. We're an engineering firm that works for the architecture industry. So we design HVAC, electrical, plumbing, technology systems for the built environment for buildings. So about 100 employees total. The headquarters in Charlotte, have several other offices around the state, and recently opened one in Greenville, South Carolina. So next slide. The ownership transition process took probably 6 or 8 years for us. Started, I think, when that picture was taken, and I had hair that was not gray, to go through that. And there's several options, as she mentioned earlier, that you have. You have the the ESOP was one we considered, selling to a competitor, selling to select employees, or closing the business. She mentioned that a friend of mine died suddenly recently and had no plans for succession. And the employees are very worried, and no one really knows what's going to happen. So you need, I think, having a plan for long-term transition is one thing, but also short-term. What happens on the management side? I know one question we've had quite a bit after we formed the ESOP. It just came up recently when we decided to open a South Carolina office. Was we're all members. One of my employees said, "We're owners now. How come we didn't get to decide about opening a South Carolina office? We didn't get to vote." I said, "Well, do you own stock in Coca-Cola in your 401k?" Yeah. So do they ask you to vote every time they want to open a new bottling plant or something? This is all about ownership, not about management, because we did not change the management structure of the company. But we went through these different options. Closing the business was not something we wanted to do. Selling to select employees, there were several who would love to, but they just didn't have the funding for it. If your business is successful over a long period of time, hopefully you get to a point where they can't afford, the value of the company. It's a problem on the transition, but it's a good problem to have. One of the things, as one of those silver tsunami people that started the business in 92, so 32 years ago, I didn't want to spend the last 3 or 4 years of my career working for somebody else and trying to figure out.
Hi, James. This is Elena Gupta. I'm returning your call. Sorry, I was in a meeting.
Elena, I think you need to mute. Yeah. So we ended up on the ESOP, and we looked long and hard at it. For us, we thought it was the best thing to do. We have a very stable employment base. We have very educated workforce, and they all seem to be understanding. It takes a while. Next slide, please.
Got it.
So when we made the decision to become an ESOP, actually was in March of 2020. And you may remember another event that occurred in March of 2020. We actually reached out to Ethan's firm as a consultant for us and said, "We want to do this." And it's not an inexpensive process to do this. I will say the overall expense of doing it, if you're going to sell to another company and you get a business broker involved, ESOP's probably a much less expensive way to go. But we reached out, and all of a sudden the COVID hit, and we drew back for about 4 or 5 months, decided let's wait and see what's happening. And later in the summer decided let's go ahead and do it. Took about 6 months to get there, to go through the process, but December 31st, we signed all the papers, and on January 1st, we became an ESOP. So next slide. So it'll be 4 years next month, which is hard to believe. It's been very good for us. We've had a lot of good things happen. The employees are starting to understand. There's a lot of education with the employees of teaching them, what does this mean? What is their responsibility? What is profitability? What is revenue and growth, and why do we care, about this, and why does it affect us? So that takes a good bit of time and reiteration. But our fiscal year end is the end of September 30. So we just went through that. And this was the first real year where we've been able the first years in ESOP, there's a lot of expenses, like I mentioned, to work it through. The paperwork, the setup, all that stuff. There's a lot of time involved. And we went from 0 debt to a massive debt because we basically borrowed the entire value of the company. So you go through that, and you got to get through that year or two, and we did. But one of the great things I remind my employees all the time is we don't pay taxes. We're 100% ESOP. We don't pay taxes. So that tax burden that goes away funds a big chunk of the debt payment every year. And at the end of your fiscal year, you're not worried about expenses and trying to get profit down because you're trying to reduce taxes. And our goal used to be to have as little cash as possible at the end of the year if we had a good year, so we could reduce the tax burden. And now we don't have to. And it's very different going into the last month or two of your fiscal year and not having to worry about that. It's like we have cash and that's okay. It's a good thing. So that's you do have a different way of running your business. I mean, I went 28 years of that tax game, you know, and some years weren't very good, so we didn't have to worry about it too much. But fortunately, most years that was an issue. So going through that is huge, and it is. I love running a business that way. It's much, much better. Next slide. So one of the bigger things we have, like I mentioned, we went from zero debt to this massive amount of debt. And in less than 4 years, we've paid about 28% of that debt down. And it's starting to accelerate. We had figured it was 8 or 10 year payback. And I'm already starting to see where we are growing and we are getting more profitable. We're working better at that. The employees are starting to understand that better, how it can affect them. And it's kind of like having a mortgage. You know, the first couple of years is tough, but as revenue grows and your debt reduces, you know, and then the interest on the debt reduces, it all kind of snowballs. I'm already projecting by this time next year we'll be probably 45, close to 50% debt gone. So that's exciting for us. We're passing on our targets, and the employees are starting to see that annual valuation that their stock is going up. You know, the first year it's very small. You know, it's not a lot for your stock value, but as it goes up and more stock is issued, we're starting to hear some chatter about it. And we just had a strategic retreat, and we went through what that looks like for the next 5 years. And our goal is to have the debt paid off. And about then, we'll probably start having some of our first retirees within this. So we can manage that. We're also looking at possibly buying a small business. And there's a lot of benefits for an ESOP buying a small business on the tax side for the other business. So that's kind of exciting if we decide to do that. The next slide, Ann, Claire. One thing I wanted to mention too, retention and recruiting. So prior to the ESOP, we had about 25% annual turnover. And now we're down to 11%. We've kind of attacked that in various ways, but I know part of that is the ESOP because it's an additional retirement benefit that everybody gets. We did hire one person who solely interviewed with us only because we were an ESOP. He came from an ESOP and he understood that. It is a good recruiting thing and a benefit, but it's still a lot of people don't really understand it. You know, you tell them about it, and retirement for a 25-year-old is so far out there. Even for the engineering group community, which is very logical and usually very plans in the future, it's not as big an issue or as big a thing, but it's still important. And so I think that's going to grow over time. And I've been privileged to have there's a lot of general contractors who have become ESOPs. And over time, the retention on that is huge. If you've been there 10 or 15 years and you've got this big stock option out there, I don't view it any different than a lot of the CEOs and the kind of golden handcuff things you see. Those stock options become very large, and they don't want to lose that. So it is long term, I think it's going to be very, very beneficial to us. Any other questions at this point, or Ann Claire, anything I should bring up?
Well, two things. One is you mentioned that you didn't want to be working for someone else in the last years of your career. How did you find out that an ESOP was an option, and what made you choose that over some other option?
I always knew about ESOPs, but I had been told years ago that you needed to be like 250 employees. You need to be very large because it costs so much to implement. Then I learned that it has gotten much less expensive to implement. That just like everything else with technology and things, it has become less expensive, and you can be much smaller. And we were probably 75, 70 employees when we became an ESOP. And I thought our employees are who got us here. That's who, all we do is sell our employees knowledge and time, as a service industry. So that's the people that should be rewarded from this, and not some other company that comes in and changes our culture and everything else. So I think we have a good corporate culture is something we wanted to continue. And so I knew a long time ago, it is not about me. Just because I started the company, the best thing I ever did was hire smart people and have them make that growth and make that work. So it was a pretty easy choice for me personally. And then we kind of went through the whole leadership group and looked at all the options, and they agreed. And by that time we had 5 other stockholders. It wasn't just me, and they all agreed it was the best way to go. And almost 4 years in, I think they'd all tell you the same thing. It was a very positive, good thing for us to do.
Nice. And what advice would you give a business owner who's considering selling to an ESOP?
I would really consider it, and don't let the initial time or financial considerations get in the way, because we didn't have to have a broker involved, which is a huge piece of money. We most of the other stuff you have to do anyway. I don't care who you sell your business to, you got to go through and audit it and get the finances and do projections and all that stuff. So it's a good process anyway for a business owner to go through that. So don't let that scare you, but it is not something you can do in a month. It takes 4 to 6 months at a minimum. And like anything else, hire good consultants, hire good people that know how to do this to help you. One of the things, we interviewed with a lot of banks because we were going to borrow money for this. And our own bank that we had banked with for years did not loan money to ESOPs. They didn't really understand them. We went to a bank in Chicago, a national bank that understands it. And they have been great because they help us too. That one of our trustees is from that bank ending up. So they knew how to help us. They know how to do it. So go to people like this organization that you're listening to today that knows ESOPs and can help understand them, explain them to you, because it is still not the norm by any means.
Got it. Thank you so much. We do have some questions in the chat. I think let's hold them for now and see if Ethan answers your questions. And if not, we're going to have plenty of time to address all these questions
All right,
a little bit later. Well, thank you, Keith. I appreciate it so much.
Mm-hmm.
All right, I am going to turn it over to Ethan to tell us about SES and the process of converting to an ESOP.
Great, thanks, St. Clair, and Keith, thanks for your comments. Great to always hear any ESOP story, and particularly a client as well. So just briefly, I'm Ethan Stambler. I'm here in Raleigh, North Carolina, where I lead our firm's effort expanding ESOP activity across North Carolina and the Southeast more broadly. SES is, as Ann Claire alluded to, an ESOP advisory firm. All we do is advise companies that are considering ownership transitions, help them understand the ESOP as an option and determine whether it's the right choice for them, and if it is, to help them through that whole process, as Keith alluded to. We've worked with companies across the country and across sectors. I think I'm newer to I joined more recently, but my partners have set up, I think, over 500 ESOPs over past decades. So we're well steeped in this. Go ahead, Ann. Thanks. So what I want to cover today is just why consider an ESOP, and I think Keith already and Ann Claire both already alluded to some of this. Want to cover specifically when an ESOP makes sense, and there are parameters and attributes that make an ESOP make more sense or less sense for a company. We'll spend some time on the detail around the structure of an ESOP, and I've been monitoring some of the questions I've seen come across in the chat, so I'll be sure to touch on some of those as well, which are all good pointed questions. And then finally, we'll spend some time on how ESOPs are formed, and as Keith alluded to, how they're managed on the back end once they're set up, both formally and kind of culturally. So why consider an ESOP as a starting point? As Keith alluded to, when anybody's facing an ownership transition on their business, there are a whole constellation of considerations, both pure dollars and cents financial, with respect to what the founders or owners need or want to achieve financially, all the way through to much more personal, softer considerations around their personal legacy, how the transition will affect everyone from their business partners to their management team, to their employees, and even to their community. And so, as we engage in conversations with businesses, all of these in some form come up, and that's kind of the starting point for determining what the right solution is. So as Keith went through in his own decision process, really I see the three basic. I don't have close the business as a fourth option here. In most cases, hopefully that's a last resort. But for those where the business has good ongoing sort of long-term prospects, I see there are three basic options. One is maintain the current ownership structure in some form. So maybe that's transition it over to family members, keep it within the existing partners that are already in place. Next option might be to sell to insiders in some form. So selling to folks that are already involved in the business. And as Keith alluded to, there were folks in his business that were interested, but didn't necessarily have the capital to actually fund that. And so, that's an example of consideration that folks would have to think through. And then finally, the last option would be to sell to outsiders, whether that be a competitor or a supplier, strategic partner, or an investment firm, a private equity firm, or someone like that. And each of those have their own, considerations to think through. Ultimately, where the ESOP sits, I think about it, there's almost a bit of a hybrid sitting between the option of maintaining ownership and control and selling to insiders. Because whether there's flexibility, which I'll talk about, but whether a company chooses to sell a portion of itself to its employees, or even 100% of its, of the company to its employees, typically the founders and owners and original owners are still staying involved and very much leading that business for a long period of time. So it's an option that kind of bridges those two when one of them individually just doesn't necessarily make sense. So again, and Claire and Keith, I think both alluded to these, but as I thought about it, when I first joined my firm and spoke to my colleagues that have been doing this for decades, I've worked in a variety of financial capacities in different industries and different parts of the financial world. And my partner said to me, the great thing about ESOPs and working exclusively on ESOPs is that when we're structuring and doing the deal and we look around the table, everyone is benefiting. The seller's benefiting, the company is benefiting, and the employees are benefiting. And we've covered some of this, but specifically for sellers, there are tax advantages to the sale. So typically someone that's owned a business for 20 or 30 or 40 years has a relatively low cost basis in that business. And so selling the business at a fair market value can trigger a pretty significant tax liability. There are ways with ESOPs to effectively defer that gain. And the government has specifically set up tax provisions to encourage business owners to do this specifically. And that's one of the enticements. We've talked about the business legacy, which can be preserved through the process. Keith talked a little bit about trade-offs with just an outright sale. There's both certainty and flexibility, which sounds like a bit of a paradox, but with an ESOP, if we've gone through the process of working with a business owner to determine that this is the right course of action for them, and they decide to move forward, almost with probably 95% certainty within 6 months, that transition will occur, assuming that nothing really surprising comes up. And the timing can be flexible on that, right? So whether they choose to sell the entire business to the ESOP to start with, or do it more gradually through a few steps, the business owner can align that, or business owners can align that transition with whatever their objectives are, and flexibility around maintaining their role with the business, as opposed to, in contrast, a sale to a third party. Typically, that third party is going to have very distinct views as to who how quickly they want that transition to occur, what role they want the original founder or seller to maintain the business. And so there's both, again, sort of this paradox between certainty around the transaction and flexibility in terms of how it's done. I won't, briefly for companies, I think Keith explained this, as well as I could. Employee retention tends to increase. Employees are more engaged. There are customers and business partners that prefer to do business with ESOPs and employee-owned businesses, or they may not even have been aware of employee-owned businesses or ESOPs, but realize when they're engaging with those businesses, they realize there's something different when everybody in the business is thinking like an owner and approaching the customers and partners in that way. And then finally, there are tax advantages there. So effectively, as an S Corp, once a company is 100% owned by the ESOP, there's no tax bill due at the end of the year, as Keith alluded to, which, I think it just feels good at the end of the year, but practically that retains cash in the business, which can then be used to fuel additional growth or, other benefits for the stakeholders. And then finally, for the employees, as Anne Claire defined early on, the ESOP creates a retirement benefit for employees. So just as someone might have a 401k, or a pension, so the government's provided provisions around that. The ESOP provides a structured, regulated retirement benefit for the employee, but it specifically holds the stock, effectively reflects the value of that employee's ownership in the company, which is growing hopefully over time and can be pretty impactful. So opportunity for a retirement benefit they wouldn't have, and really wealth creation over time that can even be passed down. Anne Claire alluded to, 5 and 6 figure balances. And, I wouldn't say this is not common, but in speaking with ESOPs that have been around for a while, there are absolutely folks working on the shop floor, retiring with high 6 figure and even almost 7 figure balances in successful ESOPs, which is just, really amazing opportunity for employees. So we can move ahead, Anne Claire. So when does an ESOP make sense? Basic criteria. So I think about these as kind of table stakes, right? If a business doesn't meet these criteria, it's probably not the right solution for them. So we're not talking about very small businesses, which are typically talking about businesses with at least $1 million in EBITDA. And for those that aren't, accounting fluent, that's, basically effectively cash profit sort of each year. Below that threshold, even though the cost of doing an ESOP have come down, below that level, just the cost of setting it up and the ongoing maintenance can just be too burdensome for too small a business. And so there are other options that can make sense, which I'm sure Anne Claire at other times would be happy to go through, whether those be co-ops or trust structures. Second, the business needs to be a minimum of 20 to 25 employees. As Keith alluded to, I think there's a perception sometimes that needs to be much larger. The 20 to 25 really comes about from a regulatory requirement. The tax incentives are so great for ESOPs, the government doesn't want them being done for the benefit of 2 or 3 employees exclusively in a tightly held business. And so you've got to have some reasonable number of employees for that benefit to be realized. A transaction size of about $2 million, and that really comes down to for a business owner looking to partially at least cash out of the business, you want, again, just similar to number 1, you want there to be enough money in play that it's worth the additional work and expense of going through the process. And then finally, a trusting environment. Again, that's a softer criteria than the others, but just as critical. I mean, these are, as Keith and Anne Claire both alluded to, these are long-term retirement benefits. The benefit of having an ESOP really largely ends up being driven by culture, as well as the tax and other sort of financial benefits. And so generally these need to be good, well-run companies with good cultures to start with, so that the employees with ongoing education can understand what the value proposition is, and frankly trust management and all the other stakeholders to deliver and ultimately manage the company for their benefit. So where ideal situation. So if a company's met those basic criteria, when does an ESOP typically make sense? First, as we've already talked about, closely held businesses where there's no other formal exit or transition strategy already baked in. There isn't a family member that's ready to step up and take over the business, or there isn't an key employee or business partner with the capital that's willing and able and wanting to step in to acquire the rest of the business or the entire business. We talked about situations where the business owner is thinking about their legacy and the legacy of the business and their commitment to their employees. We're effectively, the business owner has both financial and non-financial considerations that they're trying to solve for. If somebody's in certain industries, if somebody's looking to just max out every last dollar they could get from the business and don't, without as much concern about the softer factors, the ESOP might not be the right solution for them. But typically, when those factors are all in play, the ESOP is much, much more relevant. We talked about partial sale situations before. So again, if selling to a competitor or a strategic buyer, they're going to have distinct views as to whether they want anybody else to remain involved in the business economically and from a management standpoint. The ESOP, again, provides flexibility to either for an indefinite period have kind of a split structure with employees owning part of the business and the founder owning it, or transitioning that gradually over time. And then I won't get into the last one here, non-sale situations, but there are situations where the tax benefits that accrue to an ESOP can help to finance effectively ongoing investment in the business in certain ways. But I'll leave that as sort of ESOP, 201 for another time. This just lays out, reflects what I've discussed, that the ESOP provides kind of a hybrid mechanism across a lot of different considerations. And so it's, if there's a single factor that's driving someone, it might not be the right solution. But if it's a mix of these factors, then relative to the alternatives, it can be a really nice middle ground. Anne Claire alluded to this earlier, but just to give people a sense as to what kinds of companies are ESOPs. Anne Claire shared data for North Carolina specifically, but across the U.S., there are over 6,000 ESOPs across pretty much every state and across most industries. As Keith alluded to, I'll take a second to talk about the industries. I think it helps people think about the situations where an ESOP really can make sense. The professional and scientific and technical piece, which kind of where engineering falls, I think, as Keith alluded to, is very well represented. I think the common thread there is that these are businesses that, as Keith said, their value is entirely comprised of the assembly of talent that the founder has brought together in that business. And so you need that, that talent needs to stay together for the business to retain its value and continue to be profitable going forward. And so, in instances where, a founder could choose to try to, sell to a competitor, ultimately the employees need to be bought into it. And if all the employees didn't like it, well, there wouldn't be anything to sell. And so it provides a mechanism to really retain and further that value, even sort of compounding it as the employees are bought into it. So I think that's sort of one reason you see that. At the opposite end of the spectrum, you do see a lot of some manufacturing construction businesses that tend to be asset heavy. So the business obviously has talent. Any successful business has to have talented people in it, but those businesses also have significant hard assets, whether that be construction equipment or factories and machinery and other things that as a business and with the right talent in place and all the relationships that have been built around that business, it has a lot of value going forward. But it may not necessarily be of any greater value to another company to come in and acquire, who could go out and buy similar equipment or other assets, and wouldn't necessarily value the whole as much. And so again, the ESOP becomes a mechanism there for really maximizing the value that's preserved and realized over time. So what is the structure of an ESOP specifically? And I've simplified this a bit, and happy to answer questions as when we get to the end. But in short, a company, before an ESOP, company is owned by some number of shareholders. It could be one shareholder, could be a group of shareholders, right? Any group of shareholders. Once an ESOP is set up, the ESOP itself is a trust that is set up specifically to hold the shares in the company for the benefit of the individual employees. And so the employees are not actually directly owning the shares individually themselves. They could not go out and sell those shares to somebody else. As Keith said, they can't vote those shares even directly on questions, facing the company, except with some sort of limited circumstances. The ESOP is a trust that's set up for the benefit of the employees to hold those shares. And then each individual employee over time is allocated the value of the shares that they're due based on a combination typically of annual compensation and tenure and factors like that. If it's less than a 100% transition, the other shareholders will continue to own shares in the company. And just as when you have multiple partners in a business, the ESOP serves as one of those partners voting on high-level matters alongside the other shareholders. If it's 100% ESOP, that other shareholders drops away, and the ESOP is the only shareholder in the company. That's what gives rise to one of the significant tax benefits, that the ESOP trust is effectively a retirement account. And so just as an individual doesn't owe tax on the money sitting in their account in their 401k until they withdraw it, same thing here. The ESOP is not obligated to pay any tax on its current holdings in the company. So how do we get to this place where the ESOP owns all or a portion or all of the company? There are two basic options here, and Keith alluded to the option they took, which is on the right. But the first, so option A, which is unlevered, which basically means money they do not borrow, the money is not borrowed up front to fund it. An ESOP can be set up where the company gradually makes contributions to the ESOP. Those contributions are, reduce the tax that the company would be paying because it's an expense, just as if a 401k contribution was made. Over time, the ESOP uses that cash to acquire shares in the company. It could be acquiring those shares from existing owners who are gradually selling down their stake, or it could be, and sometimes the company actually just wants to create this as a new mechanism going forward and issues new shares to the ESOP over time. And so the owner gets diluted down as the employee stake gradually increases. So the implications there are that, as I said, it's a gradual purchase over time. There are, importantly, no upfront proceeds to the seller. This is sort of a very gradual kind of drip of value to the owner if they're selling kind of gradually this way. But on the other hand, the seller retains full ownership of all the stock that hasn't transitioned over. And so for someone who's looking to maintain, significant or majority control in the business, it allows them to have all the benefits that come with that. The other option is effectively for the ESOP to borrow funds to buy the shares. And so that allows the ESOP to buy a big block of shares right up front, maybe all the shares right up front. And that comes through a combination typically of a bank loan and then some seller financing where the shares have been sold by the owner, but the owner has agreed to get paid back over time for the loan they've effectively made to the ESOP to allow them to buy the shares. So in that instance, as the loan is paid back, and Keith was alluding to this earlier in his own situation, as that loan is paid back, the shares which the ESOP effectively owns are released down to the individual employee account. So when you first buy your house and you've got a mortgage at 80% of value, your equity stake in the house is relatively small. As you pay it down, it increases, and the same thing exactly is happening here. It's a good analogy, Keith. The benefit here is that the business owner can receive some immediate cash value for the portion of the business that they want to withdraw, with the remainder paid over time. And then for the ESOP at that point owns 100% of the shares. So even though they have to pay back the debt on it, they're getting the full benefit of any upside to the business as it goes forward. So, and again, there's a lot there. Happy to answer questions once we get there. So how are ESOPs formed and managed? So here's the process, and this aligns roughly with what Keith had alluded to earlier. It's typically about a 6-month process. This is very much my day-to-day and my partner's day-to-day. But really it starts, I'd say there's even a phase 0 that doesn't show up on here, which is work I'm doing in partnership with Ann Claire and others out in things like we're doing today to just get the word out there, meet with folks, meet with business owners, meet with folks that are advising business owners to get the ESOP on the table as an option as they're beginning to think about succession, so that they can at least, further explore it if it does make sense. Once we've had, a few conversations on that basis, and someone says, yeah, I think this really might be the right solution. The first phase is about a 60-day kind of deep dive that we do with the company, where we're engaged to go through their financials, come up with a preliminary value on the business, help them to understand, how they could realize value through an ESOP, how much that value would be, how, what the time frame would be for getting paid out, looking at the business, fundamentals to understand, make sure that the business is well positioned to actually pay back the debt if, debt's being taken on for it. And so from all of that, we can come up with a good snapshot of what the ESOP will look like once it's up and running and what the outlook would be. I'd say in most cases, because we've had the earlier conversations, by the time someone's had us take them through that process, 70 to 80% of the time, they decide to go ahead and actually pursue the setup of the ESOP. Largely because they would have realized from the earlier conversations that it didn't make sense. And one of the things we're doing is helping clients decide whether it even makes sense to dig in to that first phase. Once they've decided to move ahead, we're looking at another roughly 4 months. And that's, process is engaging service providers. That'll be important both, during the transition as well as afterwards. Key one of those, which we haven't mentioned, is the trustee, which actually is generally a third party that's hired to look out for the ESOP itself. And so we'll work with the company to develop a process to select a trustee and provide the information to the trustee that they need to decide whether this is a situation they want to be involved with. Developing materials, it's not too dissimilar, as Keith alluded to a sale process. We'll document the fundamentals of the business, put together the materials that either an ESOP trustee would need or a bank would need to evaluate the business and whether they want to finance it or serve as trustee. And so we work through all of that over the first month or so. Then we're really rolling up our sleeves and having a discussion with all the parties that are going to be involved. So effectively, we at SES are typically representing the company in a negotiation ultimately with the trustee to ensure that everyone is comfortable with where we end up in terms of value and structure and ongoing governance of the business. So there's as there should be in any good honest negotiation, there's some back and forth there, and we settle on the right outcome. Similarly, work through with the banks terms for financing. And then work with, there's some legal due diligence and other kind of detail that needs to be worked through. Again, it takes some time. There's some cost associated with it, but it's all very well trodden ground that, we, unless something really unusual comes up, we know, what the steps are and how to work through them. And then finally, like any transaction, there'll be a eventual closing, which completes the transaction where we've finalized all the negotiations. The ESOP plan and documentation are put together, and that's a detailed, almost operating manual and agreement. Really, it is contractual agreement for the ESOP that covers things like, well, when are employees eligible to participate in the ESOP? When an employee leaves, retires, how quickly are their shares repurchased from them and are they paid out? If someone chooses to leave or is forced to leave before they retire, well, what happens then? And so all of those things, there are rules and guardrails around what's fair and acceptable, but depending on the company and its objectives and a whole host of factors, there are decisions to be made about exactly where you want to set things up within, what's probably overall a reasonable universe of options. So, as Keith alluded to, from a governance and management standpoint, I think both people consider, owners considering an ESOP, and then particularly employees, once the ESOP is set up or announced, have questions about, well, gee, what does this mean now that we're employee owned? How is this business run? Right now that I'm an employee owner, does that mean I can set my own hours, right? And to jump to the end, the answer is no. Typically the management and governance structure really doesn't change fundamentally. I mean, any company of, reasonable size, either formally or informally, probably has a board of directors that consists of the key stakeholders in the business. If maybe it's family members, if it's all family owned, or partners, if they're multiple partners. Maybe they have other people involved, in the board that bring additional market perspective. That all, ultimately they're the ones that are making the long-term decisions around the business from a strategy standpoint, from a personnel standpoint, things like that. And for an ESOP, company with an ESOP, that's exactly the same structure you'd want. the only change sometimes, if somebody has not had any independent board members, we'll typically recommend bringing some independent board members in. But again, that's at the recommendation of the current owners and the management team. It's not, the ESOP trustee is not going to suddenly, pick a couple strangers and stick them on the board. Management doesn't change typically unless, there's reason to change it or over time business needs evolve. Management team typically stays in place. And for the employees, while, there are pretty significant cultural changes and benefits that can be, facilitated, fundamentally, there's no change in folks, people's jobs or reporting lines or other responsibilities. No additional influence or control over, individual business decisions. The only time an employee would have any kind of vote would be, an extreme scenario where the business, somebody's wants to completely acquire the business, or it needs, or somebody's raised the prospect of it being liquidated. And even then, they're just voting, they can pass through a vote to the trustees on what they, how they would like the trustee to vote. But again, that's kind of a once in a lifetime of a business kind of a decision. Nothing certainly day to day. And then just quickly sort of, as we've alluded to here, there's a lot of dollar and cents reasons why an ESOP can make sense for a business, but really fully realizing the value is very much also a cultural exercise. And that starts at the inception of the ESOP and communicating what is this new structure? What does it mean? Everything from, how does it change my responsibilities or not? Why is the company creating it? What does this mean for me as an employee and a retirement benefit? And, making sure the employees are clear on that. And then ongoing communication as initially when, employees look at their statement and there isn't that much value for their account, but it's because none of the debt's been paid back yet. It's making sure that they're clear that they understand that. And then just as importantly, communicating to them over time as that account balance grows, why it's growing. And if it's growing, presumably because the company's performing well, really helping them to understand, how, their roles are contributing to that. So they can really sort of begin to develop that ownership mindset if they don't already have it. And so, there's a lot there to, a lot of opportunity. Culture's tough. And so it doesn't happen overnight. It needs to be deliberate. But fortunately, and on the right side of the page here, I'd flag companies that pursue the ESOP are not operating on their own. There's a lot to work through. There's a lot that's new about it. There's an amazing community of nonprofits that really are, both beating the drum on ESOPs, but also very much, you could attend a conference probably every month of the year if you wanted to among the organizations, but really providing very practical advice and guidance, and frankly, a lot of ESOPs coming together to just share their own experiences about what's worked for them. So even as a new ESOP, there's a whole community to tap into there. And then there's also service providers specifically on, the cultural front that can help to make sure that, the ESOP makes the most of, the company makes the most of having the ESOP structure. Obviously, there are other service providers like SES and trustees and others that I haven't listed here, but specifically, like certified employee owned. The first one here has all kinds of ready to go communication tools that a company can immediately use or customize for their own purpose. So that no one's creating, you think people don't have to create things from scratch. The great game of business is an open books management program philosophy, which Claire would be happy to talk about another time. And then Praxis does some great leadership consulting for management teams.
Nice. All right, Ethan, that was fantastic. I really appreciate your overview. So let's open it up for questions now. I think you answered most of the questions, but maybe we can just look.
I think there was one about what happens when an employee retires. And also about how kind of profits and value of the business are allocated. So I guess I'll address those two. They're kind of linked. So as the ESOP acquires the shares in the company, initially there's a valuation done, and what's the starting point? What's the starting value that the ESOP is buying the shares at? And that's kind of so day one. And there's a whole process and objective third parties that opine on that. Every single year, as shares continue to be transferred over, or if all the shares have been transferred, just every year as the shares are still sitting there, they're revalued, and they're valued based on just the same way a new buyer of the business would value the business. They look at its profitability, they look at its market.
Ethan,
Keith, I think you're muted, Keith.
So every year after you become an ESOP, you're forced to do an evaluation. So you now know what your company is valued. And the employees learn that too, and the profitability and the growth, and if you reduce debt. So that's a very big positive.
Yeah, exactly. And so over time, those account balances grow, and then eventually, assuming people have stuck around, which, you know, increasingly they do once the ESOP's in place, and they approach retirement, the company, it's called repurchase obligation. The company is obligated to repurchase their shares at the then current value, which is, you know, typically quite, you know, significantly grown, and that's where the value comes through. And how that happens is one of the options that companies can, you know, set when they initially set up the ESOP. In some cases, they could just be obligated to immediately buy all the shares upon retirement. You know, obviously that creates, you know, pretty big cash outlay, especially if you have multiple employees all retiring around the same time. Or it can be paid out, the money can be set aside and then paid out gradually over 3 years or 5 years or whatever it might be. So there's optionality around that. There are also, I won't get into it, but there are options sort of as someone gets closer to retirement to actually, even before they've retired, they can transition some of the value of their account over to effectively like a 401k, just so they can begin to diversify as they get a little bit closer to retirement. But then, and if somebody leaves before retirement, again, the ESOP will have set rules as to how that employee gets bought out. But assuming that they've passed whatever initial vesting period, you know, is required, they'll get that value. It just might be that it's, you know, over 5 years or so. And that's one of the keys to a successful ESOP is keeping a good visibility on, you know, when are folks retiring? What do we think those balances are going to be? You know, we're hopefully, you know, retaining cash, as Keith alluded to. Once that debt gets paid down, there's sort of cash sitting in the business, so there's money there to buy them out. But you just have to balance sort of the, you know, benefits of reinvesting that cash for growth, or, you know, making sure you have it for.
And our buyback is a 5-year plan. But one other thing to add, I'm also a member of the ESOP. So even though I sold the stock of the business, I'm still profiting if the company grows and is profitable, just like everybody else. So the owners, the previous owners can and will still be a member of the ESOP as long as they're employed there.
Nice.
You also mentioned conferences that are all year round. We send our business manager to the big one in Vegas every fall. She learned a lot about it before we went into it, and that is a great thing to do if you're seriously considering it, to send some people to those things to learn.
Yes, I've put all the resources here. Obviously, there's our North Carolina Employee Ownership Center, but then the National Center for Employee Ownership, if you just go to their website, it's a very low cost to join, and they have a ton of resources, and they'll just pick up the phone if you have a question and answer your question. And then the ESOP Association has the big conference in Vegas. They are fantastic. They also do some local Mid-Atlantic conferences. And they've done a good job of keeping legislators apprised of the benefits of ESOP. So they are really great. Employee-owned S Corporations of America. So when 100% ESOPs convert to S corporations, that's when they are tax exempt. So ESCA has done a really good job as well. And then becoming employee-owned has a lot of resources. And they have some resources on other types of employee ownership as well. And yes, I am happy to share the slides.
And both Ann Claire and I'm sure both also happy if you reach out to speak to anybody about options.
Yes. So we still have 2 minutes if people have other questions. I would love for people to put in the chat one thing you learned today, one key takeaway. And as Ethan said, here's our contact information if you have more questions for us. And I think I forgot to introduce myself at the beginning, but I'm Ann Claire Broughton, and I am the founder and the current executive director of the North Carolina Center for Employee Ownership. And yeah, always happy to talk to businesses at no charge about what options might be good for you, and then send you in the direction of someone who can help you. So whether it's Ethan for an ESOP, or somebody else for a worker co-op, or someone else for an employee ownership trust, we're in touch with the whole ecosystem of business advisors, and we're happy to help. Sure, we can share the recording as well. Well, if there are no final questions, again, I'd love to hear takeaways, if there are any particular takeaways. Yep, happy to share the slides and the recording. All right, well, please join me in thanking Keith and Ethan for doing such a great job. We will share the slides and the recording, and thank you for being here.